I'm Gary Webster. I'm an equity release practitioner, so I'm actively operating in this market currently. I also work very closely with the Equity Release Council in terms of sitting on one of their committees, which is their policy affairs group. So the market currently sits at 1.6 billion in terms of gross lending for 2015. That's up 16% on 2014. So it's quite a big, hefty increase in the amount of gross lending. Now, within the market today, 60% of equity release is done on a drawdown basis. And I'm sure most of you are familiar with drawdown products, that the client takes what they need at the outset, and they can then set up a cash reserve which protects the roll-up of interest, and they release the money from the cash reserve as a rainy day fund as and when they require it. So that accounts for 60% of the market today. But we estimate that at least 1 in 4 plans currently being sold are sold on the basis that it is replacing an existing mortgage. Typically that is going to be a conventional mortgage, although there is a very, very small rebroke market of rebroking existing equity release plans. But it's a very, very small proportion of the market. But to put it in some perspective, the market has doubled in size since 2011 and exceeds its pre-recession peak by 33%. And when we talk about the pre-recession peak, that is when the mainstream lenders and some of the building societies and banks took flight from the equity release space. So we're doing more business today with less lenders in the market, with less liquidity available. So that must give you some comfort in terms of the potential size of the market, because there is demand. So guys, what I'm going to look at here is that really just give you a flavour for what some of the leading stakeholders, the leaders in our industry, are currently saying about equity release. Now, I did ask Robert Sinclair, chairman of the Association of Mortgage Intermediaries, the other day. Robert is here, so I didn't want to misrepresent anything. So I know he may not sue me, but I just wanted to make sure he was quite happy with what I said. But as you can see, Rob is, just to paraphrase and summarise, Rob is saying that he can see equity release being a £5 billion per year market before the end of the decade. And I'm happy to go with that too. We do feel that the market now has traction and is beginning to move. But it's interesting that Rob also says, so we're weighting the facts, that I'm still disappointed that regulators see this as an unsafe business. With independent advisors, independent solicitors, I see this business as one of the safest places in the market. Thank you, Rob. Thank you very much. Equally, we have Legal & General, who entered the market in 2015 and have ripped up tree stumps very, very quickly. And Bernie Hickman, who's the managing director of their individual retirement business and also leads the equity release piece at Legal & General. And I've always wanted to say this in a presentation. The over 60s in the UK have nearly 1.3 trillion, I like that word, trillion in housing equity. And we believe that lifetime mortgages will become an increasingly popular way for many people to supplement their income in retirement. And we have at the bottom a quote from Nigel Walterson, who is the chairman of the trade body for equity release, the Equity Release Council, and again is confirming what is being said, that housing wealth is often people's greatest asset, and it makes sense for equity release to be on every homeowner's checklist. But more importantly, going forward, is that they are looking to support advisors as the market grows as a top priority in the year ahead. So, you know, there is an interest, certainly from the Equity Release Council, to get more brokers involved in the market. So let's have a look at some of the drivers. Some of these will be quite obvious to you. Firstly, an ageing population, that's quite obvious. We know that. We know people are living longer. It's fair to say now that the average, the average pension pot the average defined contribution pension pot sits somewhere in the region of about £25,000 to £30,000. So if you map that across against the average value of a property across the UK, the average value of a property in the UK is 10 times the value of most customers' pension pots at the time they could annuitise. So it seems that creates, obviously, a driver in market, because most clients do not have the means in retirement and the expectation of earnings as they go through their latter years. Good news is there's increased competition, and hopefully with increased competition, not only are we seeing greater customer choice, but we are seeing greater liquidity. And any market benefits from liquidity, from lenders coming into the space, because it creates competition. And we are starting to see competition now from lenders with Legal & General entering the space in 2015. And what we have seen is loan-to-values moving quite quickly. So we have seen loan-to-values becoming stretched now and increasing, which has always been very, very valuable to advisors. Some of you may still be hurting from the MMR jab in April 2014, and it's by no mistake that we're seeing the market continue to increase. Interesting stat come out of the Council of Mortgage Lenders at the end of last year, and they did some research between Q1 and Q3 of 2015. And for the age group between 70 and 89, over 80% of the remortgages at that age group were lifetime mortgages. They were not conventional. And in some of the age groups, it's up to 90%. So there's a clue there. So we're seeing some of this drive, as I said, as 1 in 4 of the plans. Now clients looking to take out existing loans. But we believe there is a slight confused debate that is taking place within equity release, and that confused debate is that we keep on hearing the interest-only time bomb. Now, you can supplement those words slightly, interest-only into retirement and interest-only in retirement. They're two different debates, quite honestly. And the market that we're in, quite predominantly, is interest-only in retirement. Whilst we do see some clients who are working part-time, for most of the clients we see, they're looking to raise money in retirement. They're not working. There's no gainful employment. So therefore, that means that there is an issue with affordability. And whilst we don't get the opportunity to talk about this debate often, there are lenders in the market that will provide mortgages, conventional mortgages, at any age of clients, providing they have affordability. However, the issue with affordability, we do see a lot of joint borrowers who we know that once one of those borrowers passes away, the income ceases and there will be no affordability. And the issue in the market, that for those of you who are in it, and for those of you looking to potentially enter the market, clients do not want to downsize. They do not want to leave their family homes that they've lived in for a number of years. They want to die with their possessions around them. So you have a slight dichotomy here where clients could downsize but they don't want to and they don't have affordability, but you have hundreds of thousands of these maturities coming through from conventional mortgages over the next few years. So again, to weight the debate, again, you can read this for yourself, guys. I mean, I won't go through every line, but the FCA last month published a discussion paper which includes a consultation, and the main thing coming out from that is that the FCA is seeking to find out whether there are any barriers to stopping older people from accessing financial services products, including mortgages. Now, you could argue it's a bit of a contradiction in terms, what I've said earlier. There's big issues with affordability, so why would lenders want to take that on a conventional basis? But it's right. We feel it's right that the debate is had, because we actually think this will benefit equity release, the sector, and lifetime mortgages, because it will kill off some of the perceptions of how this market actually operates. So there are some areas of focus there, as you can see. What would improve financial markets for older consumers, distribution channels, and they will draw up their strategy from this in 2017. We welcome that. And equally, just to paraphrase, our trade body welcomes that, because again, anything we can do to highlight best outcomes for consumers has to be for everyone's benefit.